It's Eric Boyce, CEO and Chief Investment Officer of Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for February 2nd of 2025. Well, before we really get into some of the economic data and some of the other charts that I found interesting over the last week, really need to talk about tariffs because as I am recording this, the 25% tariffs on Canada and Mexico are set to take effect. It has a wide-ranging impact. I've got a couple of charts here. This one in particular, with regard to Canada, shows you the impact of those tariffs, and at least in the imports to the U.S. from Canada. So really, at this juncture here on Sunday afternoon, we're looking for the announcement of retaliatory tariffs on the part of both Mexico and Canada. And notwithstanding that, and we had the announcement on China, which we largely expected. And of course, a lot of this is driven by the Trump administration's desire to want to curb fentanyl trafficking into the U.S. And so there's a lot of rhetoric there. But again, I think, in 2018, there were tariffs that were imposed on our primary trading partners, Canada and Mexico, and with the retaliatory tariffs that came as a result of that, again, this is 2018, the U.S. actually backed down. And so I see this as being a lot of bluster. I do see there being some impact, and we can't ignore it. We have to take stock of the risk factor. And I think it does make the markets a little bit more volatile here in the near term. And it'll be interesting to see where futures open in the morning. But here we've got a chart on Canada showing you in terms of billions of dollars and also as a percent of the imports in those categories to the U.S. You can see where could Canada hurt us the most. Well, obviously crude oil, with as much as we've talked about how the U.S. is becoming much more self-sufficient with our oil production. We do get a lot of kind of a heavier grade crude that comes out of the tar sands in Canada that gets refined in the Midwest. You can see cars. I think this is going to be a recurring theme for as long as this tariff thing plays out, because you've got car parts, and if you look at the average car sold in America, a good chunk of it has passed through Canada and or Mexico multiple times before it winds up on the dealer lots. And so that could be a real impact. And I think too, there's a possibility that that the selected tariffs could be modified somewhat to try to ameliorate that problem. But just be clear that cars, passenger cars, it's a big issue. And you see downstream there, at least from Canada, you got lumber, gas, and to a lesser extent, agricultural and edible products. Excuse me. You can see the share of U.S. imports, natural gas. Of what we import on the natural gas side, all of it comes from Canada. You can see here a chunk of whatever we do import from a crude standpoint comes from Canada. You can see, obviously, lumber. We get a lot of lumber and French fries. But, to be clear, it hurts Canada and Mexico more than it hurts us. The combined economies of Canada and Mexico are 1/7 of our economy size. And so, but it can hurt. And I think what it could do more so is create uncertainty, if nothing else. But if these were to persist in the longer term, yes, there would be some near-term inflation on some of these products that are impacted. But the long-term impact would clearly be on growth as opposed to just simply inflation. Well, I spent a lot of time on that slide. Don't want to give short shrift to Mexico because Mexico's obviously very important too. You can see much more of an agricultural focus from Mexico, but still in terms of aggregate dollars, passenger cars, we see PCs and motherboard developments. We've got down there, we've got beer. So your Corona and Modelo would be impacted by that, and small electronics. And then you can see the share of agricultural inputs or imports rather from these particular categories pretty high. So you can bet your bottom dollar, that when you go to the grocery store and you're buying from fresh produce, it is going to cost you more here coming up very soon. So with that, we'll pivot over to China. You can see here a lot of conversation on China and much more centered on electronics. As we'll see in a second, we've got some charts on some critical materials and critical elements, what they call rare earths from China. So, again, the rhetoric is that China can hurt us in different ways. You can see the category or the share of U.S. imports by these categories can be pretty high coming from China. And let's be clear, China is a very important trading partner, and there is a clear competition going on, a new Cold War, if you will. But this is just an indication of what some of the impact might look like from these collective tariffs moving forward. So we'll kind of intersperse kind of where we are from a sentiment standpoint. We've got the CFO survey. These are financial executives. You can see that sentiment seems to be moving higher, not only for their own company, but for the U.S. overall. That sentiment could change, however, and what we see here, we've got maybe a little bit more current data looking at the consumer confidence, and this is a well understood metric, a well understood survey. This is a Conference Board consumer confidence. You see it tick down. We're kind of in that range that we've been in for multiple years here. Consumer expectations, notably, that had improved towards the middle part and towards the end of 2024, have kind of reversed course a little bit. Again, it's natural. We've got some uncertainty, tariffs, new administration. I think clearly the bloom is off the rose and the honeymoon phase is over, and whatever metaphor you want to use, we're kind of beginning to understand what this kind of tumultuous environment might look like. Thought I'd throw this in there. This is kind of bringing it home to a lot of people here. When you talk about, over the last several years, the disconnect that you have in terms of, the economic data that you look at a very macro level and what a lot of people at the lower income cohorts are feeling. Well, this is a good representation of that. And you can see here, this is just your bacon, egg, and cheese price index. I'll call it kind of your breakfast taco and coffee calculation here, and you can see that it's gone up quite a bit, and I think at least in the near term that could move a little bit higher. But these are the kinds of things that add up for people at the lower income cohorts, and I think would inspire them to substitute. And if they're going to buy, to kind of dumb it down, I mean, if they're going to buy 3 breakfast tacos, maybe they just buy 2, right? Or maybe they substitute, they go a different direction. But I thought that was a very interesting chart coming out of Daily Shot and off of calculations from the Bureau of Labor Statistics here. Okay, stating the obvious, we have trade policy uncertainty, which has spiked. You can see that categorized here in this chart that we get from First Trust. On the right-hand side is something that I think reprinted out of Financial Times here. You can see going back 2011, we've had some spikes in this over time. You can see the 2018-19 trade wars that, and you can see how this correlates. So this is the trade policy uncertainty index, and this is what's represented on the left-hand side. But on the right-hand side, you've got that, and then superimposed on that, you actually have the VIX index, which tracks volatility in the equity markets, and then you have economic policy uncertainty, which is another indicator there. And you can see the impact there with trade policy uncertainty moving higher. It would seem to correlate, but not a perfect correlation, but it would seem to correlate that volatility is heading higher. Here we've got some charts that kind of give some different perspective on the trade situation here. So we've got imports from China. I showed you that chart a few slides ago, but particularly for manufacturing, and we've been struggling to get back up to break even. We've had some green shoots on the manufacturing side, but Clearly, we had kind of a rolling recession in manufacturing a couple of years ago. And here you see various things. Won't go into all of them. Some of them are honestly, rare earths and critical materials that go into electronic storage, go into batteries, they go into different manufacturing, automotive. You can see rare earth, that third from the top, rare earth metal compounds. So, a pretty high share of these particular items comes from China, molybdenum down there. So you can see here clearly that, China is important. And I know the rhetoric out of Washington, without waxing politics here, the rhetoric is that these tariffs are going to inspire more domestic production. But a lot of these, materials that are being exported from China now, these rare earths, are not as readily available here in the U.S. And there's only a few places where you can get these types of things. And so, the ship really doesn't move on a dime, and it takes a long time to reconfigure your supply chain. So just showing here that, I think things are going to take a while, might be a little volatile. Here we have some 2017 exports to China, and you can see here kind of a little bit of a breakdown in different categories, without going into like a very meaty analysis on all of these. You can see it's a pretty broad swath of the economy here, and some of these are not going to face a lot of retaliatory tariffs, but some are. And you can see here that, the vehicles, we've talked about that. So we're just talking China here, but also vehicles and parts are a big component of the discussion with Canada and Mexico too. And wood products, we export a lot of those to China as well. And medical instruments, and these are high value, high dollar, high margin goods for a lot of companies. And so this is where corporate America is looking right now, those that have had exposure to China for a while, looking at their own risk profiles and doing mitigation. And you can see probably the impact on inventories and trying to get out ahead of it. But you got a lot of people saying, hey, listen, there's a lot of uncertainty out there. I can't commit dollars to move my supply chains and all of that until we have some kind of clarity in the data. And but it's also hard to replace China as an export market if this type of thing lingers throughout the duration of the Trump administration. Now we're going to pivot to the GDP number. So we got the first reading of the fourth quarter economic growth number, GDP. You can see the contribution of real GDP by sector. The overall number was expected to be about 2.6%. What we got was 2.3, which if you've been watching these for a while, I kind of highlight the Atlanta Fed. They have a GDP now indicator. This absolutely hit the mark on that. And that Atlanta Fed gauge has proven time and time again to be really on the money on this stuff. And so, let's look at the components. So I would say on balance, a good quarter for economic growth. You can see the progression in that line there. So maybe a little bit down from the last couple of quarters, but not anything, that you'd really worry about. But consumer spending was very strong, stronger than honestly it had been in the last couple of quarters. And where we saw a little bit of a hit was inventories, which can be, you can see even on this chart, a little bit volatile, and we'll see a chart on that coming up. But consumer spending is what really drove this. Here we have that consumer spending number that I just spoke about. Here you can see goods and services kind of equally split, and not always the case. We've seen goods spending kind of come back a little bit, where we've seen a lot of consistency in services. Now you go to the business side of the ledger, that was down a little bit, and some of that has to do with kind of figuring out the new landscape from the legislative standpoint. Like I said, you got a new administration, people kind of holding in, things a little bit, waiting to see how maybe opportunities develop and or maybe regulation shapes up, because this is reputed to be an administration that is going to be more business friendly, and so I think that's transmitted throughout the decision-making process here, at least for the time being. So final sales, you can see consumption very strong, very consistently strong. Really nothing to report here other than it was just a good number, 3.2% in the fourth quarter. Inventories, I just mentioned a couple slides ago. You can see that that is down, and that's a real jumpy number. And I suspect that you're going to see, ironically, an inventory contribution to GDP in the first quarter as people are really loading up on product in the channel before these tariffs really kind of go into effect. And we've talked about housing. We've had stronger housing numbers overall, although we've got a little bit of weakness near term. We do have house prices moving higher, but you can see housing investment was a net positive to GDP growth. And then trade, I'd say, is kind of a net positive, but not by much. I mean, trade flows were relatively muted in the last quarter after having been, pretty wide in the third quarter. Some of that has to do with the U.S. dollar, but we'll continue to track that. And there are always puts and takes on trade. So in this chart, we've got Goldman Sachs kind of looking ahead. Of course, we've got the first reading of that Q4 number. That was 2.3. So that really did kind of hit the consensus. You can see that kind of flat lines going in 2025 at or near 2%. Goldman tends to be a little bit more optimistic on this. Honestly, I think, when you talk about tariffs, it's a little too early to ballpark this. But I think, if you say 2.25, I think it's a pretty reasonable guess based on everything that's in front of us right now. Now we've got the Richmond Fed Manufacturing Index. That as we get this data from the regional Fed districts, like to report it. Again, it's a loose proxy for what's going on nationally, but this is really specifically the Richmond Fed district, which includes obviously Virginia, North Carolina, and that eastern seaboard there, kind of south of Philadelphia, Delaware. But you can see here from manufacturing side, looking a little bit better, but still negative, but better than what the estimates were looking for. And you see new orders still negative, but less so. So a little bit more optimism here, at least near term. Again, now that we've got kind of the tariff issue to kind of overlay on top of this, it'll be interesting to see the pace of data going forward. All right, trade balance, we talked about this earlier. This is the lowest point that we've seen in several quarters, and then you've got to go a long way back to get to net balance here. Some of this has to do with kind of inventory and demand levels at the time for the time being. You can see here that you've got U.S. good imports that were definitely on the rise here towards the end of the year. You can see that in the purple on the right-hand side, where you can see exports were kind of flat to down. Again, this some of this is modeling out the potential for for acquisition ahead of tariffs. Maybe a little bit more to do with the dollar, perhaps taking advantage of foreign currencies which are cheaper, but generally a confluence of things. But again, our net trade is at a very interesting juncture right now. A quick comment on home sales. Pending home sales, you can see on the left, are down. They were in kind of an upward sloping channel for a number of years. Obviously, the dislocation pandemic-wise, and then the aftermath. So it's interesting to see that. And then we've got the pending home sales index. Again, the same data that we've got over on the right-hand side in the black line, and that's overlaid with the 30-year mortgage rate, which we know with interest rates that have certainly moved higher. And so you can see that kind of light blue line is actually inverted. So, with that line moving down, it actually means that mortgage rates are moving higher. And that has certainly been the case as we sit here and ponder the prospects for having higher interest rates for longer. That would seem to correlate very, very closely with a decline in pending home sales, which is what the actual data is showing us right now. On a positive note, we've got consumer and household balance sheets that are looking really strong. Here you've got in the kind of the yellowish line, you've got household net or household debt to net worth. So it's a ratio. And so net debt is coming down rather significantly as a percent of total wealth. At the same time, you've got net worth as a percent or as a factor of disposable income. You can see that in the red, and that's clearly moving higher. So consumer balance sheets remain fairly strong. Whatever you want to say about, what kind of idle liquidity is on the sidelines, and we've talked a lot about how we've got money market mutual fund balances that are through the roof, and that's still the case. But you can see here that households, by and large, have done a good job of managing their debt load, and so that gives them a lot of dry powder to help perpetuate consumer spending and consumption overall. Couple check-ins on commodities coming up here. We've got gold, which has been really strong amidst this uncertainty. I'd say that's another kind of lighthouse in the tempest of the storm there, and not surprising to see gold very strong there. And also on the right-hand side, you can see inventories, COMEX, have gone up too, again, amidst the uncertainty. So you have a demand for gold as a hedge against uncertainty now. We're not saying inflation, but we're saying that it is a hedge against uncertainty. So certainly playing out in the numbers here. We've got iron prices moving higher. We've got corn prices, which have consistently moved higher throughout the fall. Again, showing you a little bit of commodity price inflation. Here we have LNG, some articles being written, and at some point maybe we'll have something that drills down on the impact of really, the Chinese AI announcement last week there, and its implications on the whole AI industry. But you've got U.S. has, I think, like 45% of all the data centers in the world, and we're expected to, have that number go up considerably. And so a lot of discussion is, how are you going to power those data centers? Because they require a lot of energy to run. And I'd say you could argue that AI is not very, eco-friendly if that's your inclination, because there's a lot of power consumption that goes into those data centers. You can see on the right-hand side, at least, the potential demand, at least coming from natural gas for that. Now, people have talked about those SNRs as a small nuclear reactors, so that's just another way to handle this problem. But on the left-hand side, this is from The Economist that shows you that while demand is expected to rise considerably, particularly to Asia and some other nations, that with the increase in production coming out of the U.S. on that right side of that, in the blue there, that we might actually be in an oversupply situation by the time we get towards the end of this decade. Quick check-in on crude. You can see that Brent prices off a little bit after having accelerated a bit, but kind of above their kind of near-term channel. But what else is really interesting here is that crude oil stocks, inventories on a weekly rolling average are very low right now, extremely low. And I think that has the propensity to keep or tends to keep prices high when your inventories are low, and even I think because of this you see lower refinery utilization rates and things like that. So you're getting less production at a time where the economy is actually pretty good. Now we'll talk about the equity markets and some of what we're seeing out there. So, yeah, I love these Bank of America fund manager surveys. I mean, they're very insightful. And again, it's not like, money I would take to the bank necessarily, but it is an indication of where the mindset, where the heads are for, some of the most astute investors that are out there. And so you can see here that you got a higher percentage of fund managers that are expecting pretty strong growth and above trend inflation. So you get growth and inflation, which honestly, if you're going to get inflation, that's how you want to get it because you're growing the economy, not because you're in another type of monetary type situation. And you can see here, January 2025 reading is moving higher. So again, kind of a little bit of a mixed reaction to that, but overall growth expectations expected to continue to move higher. Right-hand side, kind of a manifestation of this generalized optimism. You've got the expectation for mergers and acquisitions and transactions within the corporate environment to continue to move higher. It is well believed that we have troughed because we had a couple of years there where mergers and acquisition activity was actually pretty subdued, but that's expected to turn around here in 2025. Now we've got kind of a quick look at when you get to a rate cutting cycle, a lot of debate about how many rate cuts we were going to get last year. People at this time last year, they were expecting 6 or 7. We got a fraction of that, and so they were flat wrong. So oftentimes these pundits are wrong about how rate cutting cycles are going to play out, but how the market reacts to it is a different thing. And we can see here that the blue line on both the left and the right charts here represent what's actually going on now, and you can see, call it just the green lines here represent kind of the normalized range, and you've got the amber and the red that represent either a recession or growth. So we're tracking pretty well relative to historical trends after that first rate cut. And then on the right-hand side, you've got yields, which by and large generally come down, but it's not a straight line. And but the what's different about this rate cutting cycle is that you've got these yields that are moving a lot higher now, and that usually is not the case. So we are in the middle of earnings season for the fourth quarter, and we've had a lot of data now. And so I think firms by and large have been pretty optimistic. You can see the mentions of optimism in earnings calls. We've got a few more to go here in the first half of this month. We've got retailers and media companies that tend to report later anyway, but a lot of optimism out there. Now you channel that over into what people are actually doing in the investment markets, and it's really the same thing, a lot of optimism because you've got the put call ratio, which is really going lower. And so what this represents is a ratio of those people that are buying protection against the downside relative to those who are buying the exposure to potential upside. And so when this number goes down, that just means that people are more optimistic and you have less people that are inclined to want to protect their backside, so to speak, and more people that are wanting to plow forward. And that's what put call really is, and you can see it's going down. So people are very optimistic, and then again, mentions of optimism and earnings call, all pretty good. Again, we'll have to see how it plays out here in maybe month one of the 2025 tariff regime, but so far so good. Inflows into the equity market have been very strong. On the left-hand side, you kind of get a sense of where individual investors are, so strong flows there. In fact, biggest in 2 years by JP Morgan's analysis. And then on the right-hand side, what's really interesting is you get macro hedge funds, and their exposure to U.S. equities is actually moving down. So they're getting a little bit more cautious heading into year one of the Trump administration. Profit margins, as I said, really strong. You've got, CFOs. I showed you that chart. They're pretty positive. Saw, mentions of optimism in earnings calls. I just showed you that one. That's pretty strong. You can see profit margins holding in really, really well there on the left-hand side. And on the right-hand side, I thought it was an interesting chart because you've got nominal earnings growth and real earnings growth. Nominal's in the dark blue, real is in the light blue. Again, that's netting out inflation. You can see, that has trended pretty well since 2015, though. That number's been a lot higher. But what's really, I think, interesting in here is that third bar. And it's not that light or dark blue. It's kind of like that weird blue, kind of a lightish blue. Anyway, not to get caught up in colors here, but what that number represents is nominal earnings less earnings growth, or less GDP growth. So let me rephrase that. So basically earnings growth less economic growth. And so what is clear here in particular since 1995, but this has been more so over certainly the last 20 years, and especially in the last 10 years, where earnings growth has far exceeded overall economic growth. So that's the key takeaway. Earnings growth over a long period of time has grossly exceeded overall economic growth. And I think this is the real promise for long-term stock investing right here. So when we talk about the stock market, we need to talk about breadth, and that's in the process of improving. We're getting greater participation across the entire spectrum of companies within the S&P 500. We talked a lot at various points over the last few years about the concentration of growth of the S&P 500 index in those Mag 7 stocks, and that is true. And they're still very influential. The top 10 stocks in the index now account for about 30% of it. And you can see that if you look at over the last 2 years, only, as you can see here, only about a third of the index members actually beat that benchmark that was set by those very, very large companies. I do think that's set to improve a lot. Breadth meaning breadth is set to improve because you're having better overall earnings performance out of the rest of the S&P 500, and you've got Magnificent 7 stocks earnings that are expected to go down. And of course, those stocks were highly volatile over the last week with the Chinese announcement that their own kind of homegrown AI engine that supposedly cost a lot less to develop and train, and also it requires far less power. Of course, there's a lot of conspiracy theories on that they actually use ChatGPT to kind of train that model. But anyway, that being said, those stocks have been volatile, but you can see here that hopefully this trend changes when we get much greater breadth out in the market. Okay, looking at fixed income, we've got high yield bonds. You can see corporate high yield bond flows moving a lot higher. Again, that's a symptom of very good confidence. And you can see actually in that lower right here, you've got, we might be close to an overbought signal. So the way to read these charts is we have fund flows on the left-hand side, really strong into this particular asset category. The upper right, you can see spreads for both high yield and leverage loans. That's LL. Spreads are coming in really tight. And so you just don't see this unless you have a lot of confidence in what's going on in the economy. Now, the lower right kind of indicates that maybe we've got a little froth on this. We're getting ahead of our skis a little bit. And so we might have a little bit of a kind of a sell-off, if you will, in some of these categories. But the sentiment is very strong entering February. Now we're talking about the Fed funds rate, and actual numbers and the Fed rate trajectory is in the black line. You can see that basically when the Fed started reducing rates in the early fall last year, we've now taken a full percentage point off of interest rates. Purple line represents where the consensus estimates that short term and the Fed funds rate is going to be at the end of the year. And you can see the market is pricing in either 2 25 basis point cuts, roughly speaking, although the gap is 55. That basically you get either 2 quarter rate cuts or you get 1 half rate cut by the end of this year. And honestly, I think with the strength that we've seen in the economy, which is really the December theme, is that expectation may go lower as we move farther into the year, unless, of course, there's something we can't see like tariffs being sustained for longer, and that leads to slower overall economic growth, and that would increase the likelihood that we get more, perhaps more of these rate cuts. But again, too early to tell. But right now, market's expecting about a half rate or half percentage point of cuts, more or less. Okay, and then the last one, which we're going to end on, is something I found extremely interesting here, is that you look at the S&P 500 index, and the first thing I tell people is this is not your father's S&P 500. The index looks totally different. It's a lot more of a technology focused index, and it has volatility characteristics that are much closer rather to the NASDAQ index than they are to the Dow Jones Industrials. But what's interesting here is that you've seen a lot of turnover in the index as well. And so it used to be like back in the 60s, 70s here, you'd have basically, you'd have a lot of companies that would stay in the index for a long time. And that number over time has gradually gone down to where we have now that, basically you've got, you've got a lot more turnover in that index. That's all we've got today. Hope you've enjoyed the chart pack. Hope you have a great start to your February. Look forward to catching up with you again next week and talk to you soon. Take care.